Hi everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, the 27th of September 2025. I hope you're doing well. I hope you had a good trading week. I hope you are enjoying your weekend, and I appreciate you coming to my weekend review podcast. Hopefully it's going to be helpful for you. You're going to find something of value. But the format for today is, first of all, we are going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the positions, all the trades that I made last week. We're going to talk about when I entered the trade, why I entered the trade, what the setup was, what the confluence of signals were, and then most importantly, how I am going to manage the trade going forward. So I entered some new positions last week, got out of 4 positions last week, so I'll explain to you why I got out. Some of them I got out because I hit my stop. Others I got out because they went up and then they ran into some resistance and I exited fully. So I think it's a good opportunity for me today to show you how I get out to the upside, not just how I get out when I have a stop. And then after we go over all the positions, we're going to talk a little bit about trader psychology. Trader psychology is the most important skill in trading. Most people, when they think about trading, they think, oh, I need to find this system, I need to find this process, which is true. You do need a system and a process, but what's most important is that you follow your system and your process. So really, when it comes down to it, following your process is the most important skill, and we'll talk a little bit about that. Hopefully it will be helpful. After that, I did go down through my watch list last night of my master watch list, and I went through each symbol one by one. And what I'm going to share with you are a handful of markets, handful of stock symbols for next week that look interesting to me. I'm waiting for a confluence, a combination of setups, and they're not there at the moment, but they're in the range. They could get there next week, and those are ones that I'm going to share with you. And if they do get there, then I will definitely consider taking the trade. So one of the largest advantages we as retail traders have over large financial institutions is that we can sit and patiently wait for a market to get right where we want. And then we can just take the trade. It doesn't mean it's going to be a positive trade, but it sure increases the chances. And these large financial institutions, they can't do this. They are dealing with so much money. They're always kind of buying and selling, but that is our number one advantage, and we should take advantage of it. The advantage of patience and being able to buy exactly where we want, and only if it gets there. And that's what I'll be showing you. It looks like I have 11 potentials for next week, and we'll see if they get there. And if they do, like I said, I'll potentially take the trade. And if I take the trade, it's because it's a good setup, right? So, all right, let's run this U.S. legal disclaimer, get that out of the way, and then we'll get started. So hang tight. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
Okay, well, let's get started with my first current open position, which is Netflix, NFLX. You see this green box here. This green box is what is called an order block. And if you watch this channel, you know order blocks are a huge part of my trading. They're really strong. They give you such a good risk to reward ratio and a very defined trade. So this green box here, let's start off by why did I place this green box? What is this order block? Well, this order block starts here on the 29th of May. And so what is an order block? An order block is when you have a swing low. If you look back here 4 days, you have a swing low, and then followed by a swing high. And then here on the 29th, we have a lower swing low. And that is what you need to have for an order block. You need to have a swing low, followed by a swing high, followed by another swing low that's lower than the first swing low. Now, when this happens, if you go above in the future now, if you can take out this swing high like it did here, right? So here's swing low, here's a swing high, here's a lower swing low. Now in the future, if we take out that swing high, which happened here, now that changes this market structure of this particular stock to a bullish market structure. So swing low, swing high, lower swing low. We took out the swing high, changes market structure to the upside. As soon as this happens, now the lowest closing bar before market structure change, the high and the low of that lowest closing bar is the order block. And so that's why the high and the low of this bar, I move this out into the future, and this is an order block. And just because it happened in the past doesn't mean that the market doesn't respond to this level. So again, swing low, swing high, lower swing low, market structure change, that defines the high and the low of this lowest closing bar as the order block. So when this order block happens, because you take out this swing high, now it's changed it into a bullish market structure. I want to look to be buying dips back into the order block. Well, you can see it changed market structure here. It did come back. Where did it come back to? It came back to the order block, and then it went on this rip ride, right? So anytime it comes back into the order block, that's where I want to be looking to buy. Now, it can reject the high of the order block. That's a legitimate entry. It can reject a moving average or an RSI level inside the order block. That is also another entry point. Or it can simply reject the bottom of the order block. And this is a fairly wide order block. The height is pretty high. So unless there was a moving average in the middle, I would probably not be taking a rejection of the high of the order block, but a moving average inside or rejection of the bottom. And that's exactly what I did. I entered here. You can see it came into the order block. It lost the order block. And then here on the 7th of August, it closed back in the order block. So that's a rejection of the bottom of the order block. So I did enter here at 1181. Now, when you decide you have your entry signal, like I did right there, first thing I have to decide is how many shares am I going to buy? And I use two inputs for this. It's very simple. I take 1% of my total trading capital. Let's just say I have $200,000. 1% is $2,000. I take $2,000 and then I divide it by the value of the 2ATR. 2ATR just means it's 2 times the average range of the day. This is how you measure volatility, because if volatility is high, then this number is going to be larger. If volatility is low, it's going to be smaller. And so when you have high volatility, you're going to be buying fewer shares. When you have lower volatility, you're going to be buying more shares. So 1% of my total trading capital, $200,000, 1% is $2,000, divided by the value of the 2ATR, divided by 53.18 would tell me to buy 37.6 shares. I would just round that up to 38 shares. So I have my entry. I have a rejection at the bottom of the order block. I got in at 1181. I position size based upon what I just told you, right? 1% of my capital divided by the 2ATR. Now I'm in the trade. Great. What's the next thing that I do? The next thing that I do is I go right back to my 2ATR, 53.18. I take my entry price minus 53.18. I draw the line. That is my emergency stop. So if I enter this and the next day it goes all the way down to my emergency stop, or in other words, it goes down 2 ATRs, how much have I lost? I've lost $2,000. I've lost 1% of my account. If I have a $100,000 trading account, 1% is 1,000 divided by the 2 ATR. Again, so it's just, I know I have a defined risk. I'm going to lose 1% of my account if I enter and it immediately goes down 2 ATRs because we just did the math. But the good news is that this only happens about 5% of the time. The other 95% of the time, if I have a loss, I'm going to lose less than 1%. 5% of the time, I'm going to lose 1%. But 95% of the time, I'm going to lose less than 1%. And for an order block entry, my end of bar stop is simply a close below the low of the order block. So I entered here 1181. Even if it just closed 30 cents below, I would get out. It would still be a loss, yes, but it would be a much smaller loss than the emergency stop. So in every trade that I have, I enter the trade, I position size, I have my 2 ATR emergency stop, worst case scenario, and then I have my end of bar stop, which is going to be a lot closer to where I entered, right? That's by design. You really want to go into all of your trades with 2 stops, in my opinion. An emergency stop in case it all hits the fan, and then an end of bar stop that's much, much closer to your entry than the emergency stop, okay? So now I've entered, I have a rejection at the bottom of the order block. I position size, emergency stop 2 ATRs below. My end of bar stop simply close below the order block, which is very close. The next thing I do is I take my entry price and then I look for the value of the 1.5 ATR. The 1.5 ATR is 39.88. I take my entry, I add, in this case, 39.88 to the upside. That is my trailing stop level. Now, once I enter, if it gets to my trailing stop level area, now I want to tighten up all my stops. And the way that I do this is that if I get to that 1.5 ATR trailing stop level, now I'm in trailing stop mode, which doesn't mean I do anything. It just means that I'm in that mode. And that mode tells me that now that you're there, in the future, if you have a close below a previous bar's low, exit half the remaining shares you have. Okay, that has the effect of tightening everything up. It has the effect of moving everything up, which you should do in trading. Once you've taken a position, it starts to move up. You want to tighten up your stops, and this is how I do it, and this works very, very well for me. So now, everything I have talked about so far, the emergency stop, the end of bar stop, going into trailing stop mode, selling half if you have a close below previous bar's low, these are defensive moves. In other words, I take the position, and if something moves against me, I take action defensively. But I also want to play offense in my trading. And the way that I play offense in my trading is I sell a portion of my position if it moves up a certain amount each day. Okay, not everything, but a portion. And so I'm still in this trade. Let me show you how I do this. It's very simple. All I do is I take the closing price of the day. The closing price of the day is 12.1061. I take that price, I look for the value of the 0.45 ATR, which is 11.96, and I add them together. Closing price plus the value of 11.96, so we have 1210.61 plus 11.96. That is my first profit target for Monday, is 1222.57. If we get to that level on Monday, I will sell 10% of however many shares I have going into the day, right? If I have 60 shares going into the day, I'm going to sell 6. Now, I do this 3 times. 1222.57 is my first profit target. Then I take my first profit target, add the 0.45 value to it again. That's my second profit target. I do it one more time. I take my second profit target, add it to it again. That's my third. So I always have 3 limit orders going into each new day. If the market goes down, I don't hit any of the limit orders. If the market goes up decently, maybe I hit 1 profit target. If it goes up really nice, I hit 2 profit targets. If it goes up, really big day, I'm going to hit 3 profit targets. So, but again, it's not everything. It's not my entire position. It's just a portion. It's 10% of however many shares that I go into today. And this is really, it's invaluable to me because one, it reduces your position size. When you have a lower position size, you're more likely to follow your process. So it takes some of the heat off. And then if it goes up and then it comes down, you're really glad you sold some when you did, right? You sell some. If it keeps going up, you're happy you have some. If you sold some and it goes down, you're glad that you sold some, right? So I'm a big proponent of taking partial profits always, because just like in any sports game, you need to play offense, you need to play defense. I really honestly believe you have to do both. I've been trading for over 30 years, and when you trade that long, you find out what works, what doesn't work. And for me, taking partial profits helps in many, many ways. All right. So now that we kind of got the groundwork laid out, let's kind of start over here. Why did I take the trade? Rejection of the bottom of the order block. I got long, 1181. I position size. I placed my emergency stop 2 ATRs below. I placed my end of bar stop any close below the low of the order block. I put my 1.5 ATR trailing stop level, and away we go. The next day, up very nice. You can see right off the bat, took off, went up. I hit multiple profit targets, and boom, I get to trailing stop level. Doesn't mean I do anything. It just means that now I'm in trailing stop level. And in the future, if I have a close below the previous bar's low, I get out of half the remaining shares. Next day, up again. Next day, up again for a profit target. Next day, opened up, reversed. We have our first close below a previous bar's low. After reaching trailing stop level, what do? I sell half the remaining shares. And I sold half the remaining shares for a gain of 1.94%. So now I only have half of what I started the trade with. Next day, up big again, hit more profit targets. And then we kind of go up a little bit, kind of sideways for a little bit. We hit a profit target here. Then we head down, but it never closes below the low of the order block. Then we have two nice days up here big. What did I do? Again, I sold a partial position into that strength. And then we head back down. And then here we head up. So anytime it heads up with a nice bar, I exit more positions, okay? So now, currently, we're still above the low of the order block. We haven't closed below that, so I'm still in the trade. In this particular trade, the remaining shares that I have in this trade, up 2.42%. But when you take these partial profits, anytime you have a big spike up, you sold some up here. So did I sell some up here? I certainly did. Did I sell some up here? I certainly did. So anyway, the remaining shares on this trade, and this was a simple trade, just a rejection of below the order block, up 2.42%. Okay, Bitcoin. So in this particular trade, this is what is called an abandoned baby. And this bar here, highlighted in green, is what is called an abandoned baby. An abandoned baby is the day before you can see we gap down. So for whatever reason, the sentiment of the market from the previous day's close was bearish. We did gap down. But the very next day, boom, we gap up. And when you have these very fast, sudden changes in sentiment from bearish to bullish, in my experience with trading these abandoned babies, this is going to show you that more times than not in the future, prices are going to be higher. So with this is the only strategy that I use where I don't take partial profits. on Netflix, we talk about taking partial profits, right? Getting to trailing stop mode and so forth, which is great. And I do that with most of my trades. But when I have an abandoned baby, I make it very simple. Once I enter, I position size, just like I normally do, 1% of my account divided by the value of the 2 ATR. Place my emergency stop 2 ATRs below. But with an abandoned baby, the upside is a 4 ATR profit target. So I have a 2 ATR stop. I have a 4 ATR profit target. So if I'm right, I'm going to make twice as much as if I'm wrong. And in my experience with these abandoned babies, I'm right about 70% of the time, and I'm wrong about 30% of the time. But if I'm right 70% of the time, and I make twice as much as I lose when I'm wrong 30% of the time, you can see that that math works out. So here's my 2 ATR stop below, here's my 4 ATR profit target above, and off we go. So it started off really nice, started to head up, bump, 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 and then over the last week, we have moved down. So if we get to this 2 ATR stop here, I'm out. I'm done with the trade. I was wrong. If we head back up and we get back up to the 4 ATR profit target, that's where I'll take my profits. All right. So far, it started off nice, but so far it is down 2.61%. But I will be staying in this trade. Remember, this is a set it and forget it type of trade. For sure, in the future, one way or the other, I'm either going to hit the 2 ATR stop or I'll hit the 4 ATR profit target. But at the moment, still in the trade, but it is down 2.61%. All right, next on deck is CRM. Well, CRM is an order block, but it is a bearish order block, so I am short this position. So if you remember, a bullish order block, we need a swing low, followed by a swing high, followed by a lower swing low, and then we need to go up and take out that first swing high, which changes the market structure from bearish to bullish. Well, there are bearish market structure, there are bearish order blocks, which are the opposite. And you can see the opposite is here. We have a swing high, followed by a swing low, followed by a higher swing high, and then a big move down that took out that swing low. Well, when that happens, it changes market structure from bullish to bearish. And when you have a bearish market structure, I want to be looking to short rallies that reject the order block or moving averages within the order block. So this big bar, as soon as this big bar happened here and took out the swing low, because this is bearish, the highest up bar close before market structure changed to the downside is the bearish area. And I got short here on the 9th of September because it rejected the 50-day moving average, which is the gray line inside of the bearish order block. So remember now, shorting in the order block is the correct move, right? Because you've changed market structure. I wanted to short rallies, but I have the benefit of having the 50-day moving average here as my line in the sand. So here on the 9th, we rejected the 50-day moving average. So in other words, it got to the 50-day moving average and then closed below it. So that's my entry signal. I got short here at 252.04. Now, as soon as I get short, I position size, 1% of my capital divided by 2 ATRs. I place my emergency stop, as always, 2 ATRs above. But my end of bar stop on this particular trade is just simply a close back above that 50-day moving average. It doesn't have to close above the high of the order block. I want to keep that risk to reward as close as possible to give me the best risk to reward. So again, I shorted CRM at 252.04 because it rejected the 50-day moving average inside of the bearish order block. position size, place my emergency stop 2 ATRs above. My end of bar stop is simply a close above this gray line, simply a close above the 50-day moving average. Now, I'm short, so I still place my trailing stop level, but I place it 1.5 ATRs below me. Well, the next day, big day, it got to trailing stop level. And in addition to that, I think I hit 4 profit targets on this day. So I immediately locked in lots of profit on this day. Now I'm in trailing stop mode. Next day we went up. And by the way, when I'm in trailing stop mode, if I have a close above a previous bar's high, I will get out of half the position. It's the opposite because I'm short, right? So next day it goes up, but it didn't close above the previous bar's high, so I stay in the trade. The next day it tries to rally, fails again. I lock in more profits. I hit another profit target. The next day down again a little. The next day down again, I hit multiple profit targets to the downside. So I'm continually reducing my position size. Now, the next day, we close above the previous bar's high, right? I'm in trailing stop mode, so what do? I cover half of my position, right? Because that's what the rules tell me to do. And I locked in a gain of 4.04% on half the remaining shares. From there, we take off, we go to the upside, so I have no profit targets. This day here kept me in the trade because it closed above the 50, or did not close above the 50-day moving average. So I stayed in the trade. Had it closed above the 50, I simply would have been out. The next day we open, we go higher, but we end up closing lower and still again below the 50-day moving average. And I hit multiple profit targets. So again, reducing position size. Next day we went up a little bit. Next day down. What did I do? I hit more profit targets, locked in more profit targets. So this short position has done very well. The remaining shares that I have in this particular trade are up 3.55%. Okay, Berkshire Hathaway, been a nice, decent little trade, very nicely set up trade. You can see we have an order block here, which is the green box. And really, it's my favorite trade. It is an order block, a rejection of the order block, and a rejection of a major moving average. When I talk about rejections of major moving average, I categorize those as deep dip buy strategy. And I've used these for many years. I teach this to my students. I have a really good online video course at udemy.com that talks about deep dip buys. It's a 9.5-hour course. The link is in the description of this YouTube video, the Udemy link. It's a really great course. If you'd like to take it, it's very affordable and you will learn a lot. Like I said, it's 9.5 hours of content, so check that out. But this is a combination of both order block and deep dip buy. So let's find the order block first. The order block, well, you can see my order block. Why is this the order block? Because we have a swing low, followed by a swing high, followed by a lower swing low. Now in the future, if we take out the swing high, it will change market structure to the upside. So swing low, swing high, lower swing low, boom. Right here, we take that out. That changes market structure to the upside, and it also, at that moment, now I know exactly where the order block is. The order block is the lowest closing bar before market structure change, the high and the low, the lows and closing bar. That's why I drew the green box. This is the bar. We move it into the future. Now, as soon as it breaks out of that order block, I don't buy it. I'm waiting for a move back into the order block. Well, that happened here on the 10th of September. What did we do? We did two things. One, we rejected the high of the order block, meaning we came into the order block and then closed above it. So that's a rejection of the high. So that is order block entry. And then we also intraday rejected the 200-day moving average. That is deep dip buy entry. So it's a combination order block deep dip buy, which really is my favorite setup because you're getting two confluences. So I entered here on the 10th of November at 489.46. I position size correctly. I place my emergency stop 2 ATRs below as always. My end of bar stop is simply a close below this 200-day moving average, the black line. So it gives me a very good risk to reward ratio because look how close to the 200 I bought in the first place, right? So that's the setup. I enter, emergency stop 2 ATRs below, end of bar stop, close below the 200-day moving average. Orange line up here is my trailing stop level, 1.5 ATRs above. Next day, takes off like a rocket ship. Perfect. I sold into strength. I hit multiple profit targets. Okay, didn't quite get to trailing stop level. And then we get 3 days down. No profit targets, nothing. But the key thing is that we held and closed above the black line, above the 200-day moving average. That kept me in the trade. Next day up, hit a profit target. Next day down, but it closed above the 200. It kept me in the trade. Next day up, profit target. Next day up, profit target. Next day up, profit target. And then, of course, Friday was a nice, I should go back here to the 23rd. On the 23rd, we touched the orange line. That means now I'm in trailing stop mode, which just means in the future, if I have a close below the previous bar's low, I get out half, right? Next day, open down below, but closed above. And then nice big up day on Friday. So with this particular trade, I am now in trailing stop mode. And again, I took profits into that day, or into Friday, because it moved up. So it's a nice trade, working out well so far, up 2.13%. Okay, let's go to McDonald's, MCD. Very similar to what I just showed you on Berkshire Hathaway. We have an order block, the green block, and we have a major moving average deep dip buy, 200-day moving average here. So just to show you again, why is it an order block? Here we have a swing low. Here we have a swing high. Here we have a lower swing low. The next day goes above the swing high, changes this into a bullish market structure and defines the order block. So again, I'm not buying the breakout, I'm waiting for a pullback into the order block. But interestingly enough, look what happened here. Again, swing low, swing high, lower swing low, market structure change, pulls back into the order block, and what happens? It's bought up nicely. Didn't take this, but again, this order block going into the future still holds. It's an important place. And so I was talking about McDonald's up here. I'm not buying it up here. I'm just saying there's an order block below. If we come back down to that order block, then I'll be interested in buying it. And the other thing I mentioned, if you remember, you see the gray line here and the black line here? When the gray line crosses over the black line, that is called a golden cross. And what I've noticed in my 30 years of trading is that when you have a golden cross that happens, the first pullback to the 200-day moving average is a good entry point. It just tends to do this. When you have an order, when you have a moving, when you have a golden cross, when you have the 50 crossing the 200, the first rejection of the 200, that tends to be a good entry point. So I had lots of different things going on here. Rejection, now this is inside of the order block, but a rejection of the 200-day moving average inside the order block. It's the first touch of the 200 after the golden cross occurs. So all in all, lots of entry signals. So I entered here 301.07. I placed my emergency stop 2 ATRs below as always. My end of bar stop simply a close below the 200-day moving average. And I placed my 1.5 ATR trailing stop level above. The next day takes off. I hit some profit targets, a couple days of sideways motion. Next day, a move up, profit target. And then Thursday was down. And then on Friday, we are up again, where I hit another profit target. So we are not yet in trailing stop mode. Have to go up to the orange line to do that. But if it does, say Monday it goes up to that line, now I'm in trailing stop mode. Monday, if it goes down and closes below the 200-day moving average, what am I going to do? I'm going to get out, right? but my entry was so close to the 200-day moving average, and that's what I'm always looking for. I'm looking for good risk to reward ratios where my entry is very, very close to my end of bar stop. So this particular entry, or this particular trade so far, doing okay, not bad, up 1.38% on McDonald's. Okay, so WES is a new position that I took here on the 23rd. And surprise, surprise, it is an order block with the rejection of a moving average. So here is our order block. Again, why is this our top order block here? Because we have this area right here, the top order block. There's another order block below. So we have a swing high. Excuse me. We have a swing low, followed by a swing high, followed by a lower swing low, followed by a breakout of that swing high. That this changes structure to the upside and defines the order block. Well, here's the order block, the high and the low of this bar, moving forward into the future. So I was really looking for a pullback to the 200-day moving average, which happened here. I didn't take this particular trade, but obviously it would have been a good trade, right? But what I did was I entered the trade here on the 23rd because we rejected the high of the order block, right? The previous bar closed in the order block. The next bar closed above the order block, so that's a rejection of the high of the order block. And we also rejected the 20 EMA, which is the blue line. Now, it's very unusual that I'll take a trade in an order block based upon the 20, but I really don't differentiate between any kind of moving average inside the order block because I'm just looking at that moving average, whatever it is, whether it's the 200, the 300, the 250, the 50, the 100, or in this case, the 20. This just gives me a structure for the trade. I don't want to enter with a rejection of the high of the order block and then wait all the way for it to go to the bottom of the order block. That's a bad risk to reward, right? So I'm just using this 20-day moving average, this blue line here, as my entry. So I exit here 38.56. Placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below that blue line. Placed my 1.5 ATR trailing stop level above. And next day takes off like a rocket ship. Took multiple profit targets. The next day, up again, not enough for a profit target. And now I'm in trailing stop mode. And then Friday, of course, we had a huge move up. So I sold into that strength. Now, this is a good teaching moment. If I look at the RSI is 62.99. And we are, WES closed much lower than its high was intraday. So all this means is that at some point on Friday, WES got to a 65 RSI level. If I ever get to a 65 RSI level, now the 5 EMA comes into play as a trailing stop level. So I'm in 65 RSI mode, essentially. And all that means now is that in the future, if I close below this 5 EMA, this thin blue line, I'm simply out of the trade. That's it. Now, if it continues to head up, obviously I'll continue to take multiple intraday profit targets. But if we get to a 70 RSI level, now I have other rules that come into effect. And if I reject the 70 RSI, if I reject the 70 RSI, I'll sell half of my position. And then after that happens, if I have a close below a previous bar's low, after reaching the 70 RSI, then I'm completely out of the trade, right? So it's a nice position to be in on this trade. Again, if it goes down and closes below the 5 EMA, I'm out. If it continues up, I take partial profits, rejects the 75 RSI or the 70 RSI, then I take half. So It's important in trading that you know exactly what you're going to do regardless of what the market does, everyone. Whether it's to the upside, whether it's to the downside, you have to know. And you can't rely upon how you feel that day, right? We're all human. We all have human emotions. If you really want to make money long term in trading, you have to get yourself a mechanical process, in essence, and follow it. Really, that's, and whether you learn it from me, and I do teach private one-on-one lessons, I teach students all over the world, and I teach them a process that they can feel confident in, that if they follow over time, they're probably going to do pretty well if they follow, just like me. When I follow my processes perfectly, in the long run, I always make money, right? And I'm very good at following my process, right? I mean, I got to practice what I preach, right? So anyway, on WES at the moment, this trade's doing quite well, and it took off nicely right out of the bat. This particular trade is up 2.21%. Okay, so those are my current open positions. Netflix remaining shares up 2.42%. BITO remaining shares down 2.61%. CRM, the short, up 3.55%. BRKB, the long, up 2.13%. McDonald's, the long, up 1.38%. NWES, the one that we just looked at, up 2.21%. So now let's go to the positions that I closed last week on the daily. And let's start with Love. LUV as the symbol. So I got into Love all the way back here on the 21st of August. Rejection of the 250-day moving average, which is a deep dip buy signal inside the bullish order block. I got long 3108. Next day, boom, takes off like a rocket ship, gets me to trailing stop level. Nice start of the trade. Next day down, next day up, more profit targets. Next day kind of sideways. And then the very next day, we have our first close below a previous bar's low after reaching trailing stop level. I sold half for a gain of 5.53%. Then we came back down. This is interesting here. I stayed in the trade even though I was so close to my stop because I was looking for a close below the 250-day moving average, the purple line. It never happened. The market tested it 1, 2, 3, 4 times intraday below the 250, but kept me in the trade because it closed above. So there were no more sellers here. So here, profit target, pull back, retested the 250. It held. Nice big up move. Again, taking more profits. Kind of sideways. Big up here where this is an important day because I hit multiple profit targets and, hit multiple profit targets. And then the next day was the important day because this day got me to the 65 RSI level. So now I'm in 65 RSI mode, which means in the future, if I have a close below the 5 EMA, I am completely out of the trade. Well, what happened the very next day? We closed below the 5 EMA, and that's the end of the trade for me. So the remaining shares that I had on LUV, I locked those all in for a gain of 2. What's that? Can't read that. Yeah, 2.69%. So I am out of this trade, and again, why? Because I got to 65 RSI, and then I closed below the 5 EMA. So locked in the remaining shares there for a gain of 2.69%. MSTR, wow. This is an interesting trade, and it's a good teaching moment. So I got in MSTR here on the 16th of September. Higher low V2 is one signal, and a close under, close over the 250-day moving average. Now, a higher low V2 is when you have a higher low V2, V1 or V2 inside of the value zone. The value zone is this green line and this green line. Anywhere inside these green lines is the value zone. And what we need is we need a close below the low of the value zone, which happened here. We need a rally into the value zone, which happened here. We need a pullback, and then a V1 or a V2 that forms inside the value zone, which has a higher low than the previous lows. And if you want to learn more about V1s, V2s, just go to my YouTube channel. There's a video on there, but I use V1s and V2s all the time. V2 in this case is bar 1, 2, and 3. Here we have bar 1. Bar 2 goes under bar 1's low. Bar 3 closes above bar 1's close. That's the entry signal, and it happens in the value zone. And like I mentioned, in addition to that, the previous day we had a close under the 250-day moving average and then a close above the 250-day moving average. So we have two signals: higher low V2, rejection of the 200-day moving average, 250-day moving average. I got long 333.33. Now, when I have a higher low V1 or V2, your end of bar stop is a close below bar 2 of the V2. I know this is kind of complicated. It sounds complicated. If I was listening to this first, I'd go, what is he talking about? But again, a V2 is bar 1, bar 2, bar 3. 2 goes below bar 1's low, closes above bar 1's close. My stop on this particular entry is a close below halfway the washout bar. The washout bar is bar 2, the second bar. Take the high and the low. I draw a line in the middle. That is my end of bar stop. If I have a close below that, I get out, right? So the next day, it goes up and then closes below. It's a down day. But you see how we tested this halfway? It's my stop, but closed above. That kept me in the trade. Now the next day was a rocket ship all the way up. So I sold multiple profit targets into that strength, which, based upon what happened in the future, was very important that I reduced that position size. And in addition to that, I got to trailing stop mode. So now I'm in trailing stop mode. Next day down, no profit targets, anything. The next day down again, and what did it do? It closed below the previous bar's low after reaching trailing stop level. What do? I get out, but I got out of half the position still with a 0.74% gain, which is hugely important. So you can see in this trade in particular, selling into that strength was very important with the partial profits. And then following my rule, my trailing stop rule of a close below a previous bar's low after reaching trailing stop, I sold half of the entire position for a gain of 7.4%. Next day was down. Next day, down again. What did it do? It closed below my end of bar stop. So what did I do? I got out of the trade. Oops, sorry. I got out of the trade for a loss on the half of the remaining shares of 3.18%, which is no fun. But look what I avoided the next day. So you can see that level was important, and when we lost it, I got out. So all in all, this trade a little bit of a loss, but not much, because one, I got out of the shares on the upside. Trailing stop level got me out of half, still at a profitable level, and then I followed my rules here. Now, if I had not followed my rules because I didn't have a close below halfway of this washout bar and I stayed in, yeah, big, huge day down on Monster. So I'm, grateful that I followed my rules. And if you're still in the trade here, now what do you do? You're like, do I just get out? Do I whatever? The first loss is the easiest loss, everybody. Get yourself a process where you have a good risk to reward ratio. You know exactly where your end of bar stop is. And if it triggers and gets you out, just get out. Because if you don't get out and it continues down, now that's a rocky road. All right, so the remaining shares on MSTR, I did get out for a loss of 3.18%, but I'm glad that I did, obviously. Meta, I closed Meta out this week as well. I got into Meta here on the 12th of September. We were just talking about higher low V1s, V2s. This was a higher low V1. We closed below the value zone. We came into the value zone. We pulled back. We created a V1, bar 1, bar 2. Bar 2 goes under bar 1's low, closes above bar 1's close. I got in 756.02. Placed my emergency stop 2 ATRs below. My end of bar stop is what? A close below halfway the washout bar, just like on MSTR, the red line. Next day, up nicely, sold into profits. Next day, up again, sold into profits, got to trailing stop level. Then we moved sideways. We went up, more profit targets. This here, on the 19th, we got to a 65 RSI level. So if I get to 65 RSI level, what comes into play? The 5 EMA. And the very next day, we close below the 5 EMA. What do? I get out, right? Because we got to 65 RSI level. And once I do, now a close below the 5 EMA gets me completely out of the trade. And I follow the trade for a gain of 1.26%, which was good because look, after I got out, we're down 3 out of 4 days. So that is why I use that 5 EMA. If you get up to a 65 RSI level, you're doing pretty well. And then if you lose that 5 EMA, that could be a signal that things are turning down, and that's exactly what happened. So I got out of Meta on the remaining shares of 1.26%. And again, I sold into all this strength on the way up. So decent little trade on Meta and definitely out. And ESTY is the last trade that I got out of. I got into ESTY all the way back here on the 4th of September. Rejection of the high of the order block. You can see during the day we went in the order block. We closed back above it. This was a narrow order block, so that's why I took that trade. In addition to that, we had a V1. Bar 1, bar 2. Bar 2 goes below bar 1's low, closes above bar 1's close. That's not a primary signal. The primary signal was a rejection of the high of the order block, but the V1 on top of it just helped improve the quality score of the trade. So I got in 52.22. I placed my emergency stop 2 ATRs below. My end of bar stop is a close below the low of the order block. I placed my 1.5 ATR trailing stop level above, and off we go. Next day, up nicely, profit target. Next day, up huge, multiple profit targets in trailing stop mode. Couple days sideways motion, another couple days up, nice, where I hit some profit targets. Here we have our first close below a previous bar's low after reaching trailing stop level. What do? I sell half of the position for a gain of 9.53%. Next day up, more profit targets. Next day up, multiple profit targets. Next day up, multiple profit targets. Now, again, another example. This day here on the 18th put me into 65 RSI level or higher. So what comes into play? The 5 EMA. Next day didn't do much. Next day we have our first close below the 5 EMA after reaching 65 RSI level. What do? I take off the remaining shares. I am out of the trade, and I got out of the trade and locked in a gain of 15.34%. Really nice trade, and I am out of ESTY. All right, is that all of them? That is all of them. So just to recap on the remaining shares on Love, got out for a gain of 2.69%. Got out of Monster for a loss of 3.18%. Meta got out of the remaining shares for a gain of 1.26%, and then ESTY, the remaining shares got out for a gain of 15.34%. So exited 4 positions this week. That's good. Glad to see that. All right, now let's go to the weekly trades, and we've got 4 of those. I'll try to do these quickly. Weekly trades, I use weekly bars. Weekly bars close on Friday, and I make my decisions on Friday. So I got into XLV again. Each bar is a week. I got into XLV on the 8th of August at $130.07. Why? Because we rejected the 300-day, the 300-week moving average, and we rejected the high of the order block. So I got in 130.07. I position size correctly. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 300-week moving average, which is the orange line. I placed my 1.5 ATR trailing stop level 1.5 ATRs above. The next bar up nicely, big, multiple profit targets. Next week up again, another profit target, and I'm in trailing stop mode. Then we move sideways for a couple weeks, nothing. Next week we go up intra-week, I hit a profit target. And then finally, this week, we have our first close below a previous bar's low after reaching trailing stop level. I took off half of the position for a gain of 4.01%. Pretty nice, right? Pretty nice. And I still have half the remaining shares. Okay, UUP, which is the US dollar, been in this trade for actually several months, but a really good entry signal. You can see the green box. This is an order block. On the week that I took it on 7/11/25. I got in at 27.21. Why? Multiple confluences. Close under, close over the 200-week moving average. That's a deep dip buy. And rejected the order block, right? We were in the order block. We closed above. That's a rejection of the high of the order block. So I got in 27.21. Position size, emergency stop, 2 ATRs below. Where's my end of bar stop? Simply a close below the 200-week moving average. Place my 1.5 trailing stop level above. Next week, up, profit target. Next week, pull back, retest the 200. It held. Next week, up, multiple profit targets, got to trailing stop level. And then here on the 15th, we have our first close below a previous bar's low after reaching trailing stop level. I got out for a gain on half of 0.51%. Went sideways for a week, or for a month, and then 2 weeks ago, we were down, we rejected, closed back above, and then this week up for a profit target, and this particular trade, remaining shares up 1.38%. Almost done. TLT, weekly trade on TLT. Been in this one for a long time, everybody. I'll go through this quickly. But I entered all the way back on this trade on the 17th of January. Rejection of the high of the order block plus a V1. I got in 87.20. For a few months, we went straight up where I hit multiple profit targets, got into trailing stop mode here, had a big move up here, or again, so hit multiple profit targets, and then we had this big, huge crash down, which obviously I was in trailing stop mode. We have our first close below previous bar's low. I had to get out for a loss of 0.58%. And then we've been all over on this, but we never closed below my order block, which kept me in the trade. And every week that we had a big up move, I took profits. So finally, we had this up move in the last month and so the remaining shares on this particular trade up 1.96%. But the one thing I want to point out about TLT is I've been in this trade for almost 10 months. And the nice thing about TLT is it does pay a dividend. It pays it pays a dividend on a monthly basis of 4% per annum. So all in all, this has worked out really well. Nice return, both from the capital appreciation on the bonds and for the dividend. So this is a really long trade. I've talked about this every single week. It's, sometimes you get these trades that you just stay in for a long time, and for me, that's fine. So the remaining shares up 1.96%. All right, last one, thank goodness. Amazon. Amazon has been a short position based upon a bearish order block. I'll just refresh your memory. Swing high, followed by a swing low, followed by a higher swing high, followed by a market structure change to the downside, Once the market structure changes to the downside, I want to short rallies back to the bearish order block. All right, I picked this level here, 233.70, as my kind of own line in the sand within the bearish order block. I based it upon the bar here on 2.7, where we had a big down bar. If you have a big down bar and you rally back to halfway of that big down bar, there generally tends to be resistance at that level. So I have two things going on. I have a level in a bearish order block that should fail, 233.70. So in the future, if I reject it, I will take the trade. Well, I took the trade here on the 15th of August at 230.90 because it rejected that level, that 233.70 level inside a bearish order block. So I had a lot of things going on for me on this trade, and it gives me a very good risk to reward ratio. So I got short 230.90. I placed my emergency stop 2 ATRs above. My end of bar stop is simply a close above this 233.70 level. Multiple times it got above, but it never stayed above. All right, so that kept me in the trade. I have my 1.5 ATR trailing stop level below here. Well, you can see this week finally went my way. It broke to the downside nicely. I did hit some multiple short profit targets to the downside, but not to trailing stop level. But so far, this particular trade on the short side on Amazon, based upon this bearish order block, doing quite well, up 5.04%. So as a recap on the weeklies, the remaining shares I have on the XLV long up 4.01%. Remaining shares I have on UUP up 1.38%. TLT, the remaining shares I have up 1.96%. And the remaining shares on the Amazon short position up 5.04%. So I've shown you a lot of trades here, both dailies, weeklies, open trades, closed trades. Were they all positive? No. I had a few losers in there, which is quite normal. But in trading, it's acceptable to have big gains. Big gains, right? Well, I had some big gains, obviously, on ESTY, right? Was a big gain. Um, Love was a big gain. That's fine. Amazon on the short side, big gain. I had some small gains like uh, uh, Love, Berkshire, McDonald's. Fine. I had some small losses, right? I did have some small losses like BITO, MSTR, but I don't have any big losses, and that's the key. Big gains, great. Small gains, great. Break-even trades, great. Small losses, great. You just need to keep yourself away from large losses. And the key is get yourself a process, everybody, that keeps you in a winning trade. I mean, look at TLT. I've been in that thing for 9 months, right? But I didn't get out because I'm not supposed to. But good traders, if you look at their records, they will be in bad positions a very short amount of time and they're out. They'll be in good positions a long time. That's proper trading. And that's how I trade, and that's what I teach my students. So let us now talk a little bit about trader psychology, and then we'll take a look at the trades that I'm looking at for the upcoming week. And I think I've got some pretty decent ones. But let's first talk about trader psychology. Okay, so this is a little different trading psychology than I normally do. I had someone send me this. This is from the community board over on TradingView. And these are just some messages and some bulletins that they put out, but I think it really encapsulates how brutal trading can be. And I don't say this to scare you, but I'm just trying to give the reality of what can happen to people in trading if they don't have a good trading process that includes proper position sizing, because what happened to these people would not have happened if they used proper position sizing. So just an overview of what can happen when the market's trading at all-time highs and people are using, triple leverage, quadruple leveraged positions, things can go bad in a hurry. As a matter of fact, I have a friend of mine has a lot of Bitcoin. He called me and asked me about Bitcoin, and I said, "What's your position size?" He goes, "Well, I'm about 3x leveraged." I said, "You have you're 3 times leveraged at these levels?" He's like, "Yeah." Is that a problem? I'm like, "Oh my god, of course it's a problem. What do I do?" I said, Get out of your leverage immediately." I'm not a big fan of leverage, but had he not, if we had not had that phone call, he may have been one of these people here. And so let's read this. Trading is hard. Lesson from market brutality. Woke up today to the news that reminds us just how unforgiving this game is. In the past 24 hours, over 404,000 traders were liquidated, with total liquidations reaching $1.7 billion. The largest single liquidation order was $12.7 million on BTC USD swap. So liquidation, what does that mean? That means you got a margin call from your broker to ask you to put up more money to keep a position. You didn't have the money, so they liquidated it for you. They have to. They have to protect themselves. So you had 404,000 traders that got margin calls and got liquidated. It's horrible. This would have never happened if they would have positioned size correctly and not used leverage. So that's the reality. And if anyone ever tells you trading is easy, be wary of such be wary of such people. That is not me. I am not telling you that trading it is easy, right? This post isn't meant to scare you away from trading. It's meant to show you how harsh the truth of what you're signing up for. Better to see it clearly now than learn it expensively later. So true, everyone. Trading is hard, brutal, merciless. The market doesn't care how smart, strong, or experienced you are. It will humble you, strip you, and leave you helpless if you let it. As a matter of fact, the smarter you are, the more difficult time you're going to have with trading. I understand this from, with the students that I teach and people that I know. The smarter they are, the more difficult they have. For some reason, they have a harder time just following the process. The perfect strategy, if it exists at all, is not enough. Risk management cannot be overemphasized. Emotions creep in, no matter how disciplined you think you are. And even when you're standing tall, one small step can knock you flat. That's the reality, everybody. And I'm just kind of saying this morning. Get yourself a setup, a process where you have things under control. The math is in your favor. You have a good risk to reward ratio. And so I think this post is apropos based upon where we are with this market. Everyone thinks it just goes up, and it has gone up, but there is a time where things will change. I don't know when, but I promise you they will change. And if you don't have your affairs in order in trading, you may become one of these people that gets liquidated. So, like I said, not trying to scare you here, but I thought it is apropos for the market that we have. So be in this game for the long term. Set up, structure your trade so you can be in this trading game for the long term. You can make a lot of money year after year after year, but you have to stay in the game. All right? Okay. So on that happy note, let's go over the potential trades for next week, and then we will be done for the day. So here I have 11 different potential symbols, 11 different potential setups for next week. I mention this every week. It is possible that all 11 of these could trigger on the same day. And so that you ask the question, well, if you have 11, Greg, are you going to take all 11? No, I only take one trade per day. If all 11 of these trigger, I promise you there will be one that's better than the other 10. How do I know that? I know it because this is what I do. I give a quality score to every trade that I have. If one trade has one signal, the other trade has two signals, okay, I'm going to take the one that has two. If one has 5, I'm going to take 5. But maybe the one that has 5 doesn't have a good risk to reward ratio. Now I have to figure that in, right? I have to factor that into the equation. So how many signals do you have? What's the risk to reward ratio? What does it look like on multiple time frames? What is that market doing compared to the rest of the market? Or in other words, what's the relative strength of that market compared to the rest of the market? This is what I teach my students, everyone, is the ability to narrow down to the best trade of the day, everything considered. And like I mentioned before, I teach a one-on-one course. It's a 20-hour course. It's a serious course. It's like a college course, right? And I have taught people from all over the world, from absolute beginners all the way up to advanced hedge fund trader and everywhere in between. I love to teach. I teach really good setups. I teach you proper trading processes that you can use for years if you follow them correctly. And if you take my one-on-one course, you're going to be a better trader. You're going to save years and years of school of hard knocks. And so if you're interested and you would like me to be your teacher and teach you everything I know, just send me an email. My email is in the link in the description. I know you're going to be happy that you did. I have many, many successful traders, and I love to hear the success stories. So if you're interested in that, my email is in the link in the description. Just send me an email. We can get a conversation started. In addition, as I mentioned before, I have a really good online course, the Deep Dip by Stock Trading Strategy, available at udemy.com. In that particular strategy, 9.5 hours of just the Deep Dip by setup, right? In my one-on-one course, of course, I teach you all the Deep Dip by setups, the order blocks, the higher low V1s, V2s, the abandoned babies, so forth and so on. So anyway, I'd love to have you as a student. The course is worth every penny, so just send me an email. We can get the conversation started. So let's start with potentials for next week with Budweiser. All right, I like Budweiser. I like this trade. We have an order block within an order block, which is kind of interesting. We have an order block on Budweiser all the way back here. This order block started on the 8th of April, 2025. So way back here, we have an order block. We have a swing low, we have a swing high, we have a lower swing low, and then we take off to the moon. Once we took off to the moon and took out that swing high, we identify this is your bullish order block going into the future. Well, take a look. Back here in July, we got right into that order block, and that's exactly where we bounced. So now we are in the order block again, but we had a new order block within the order block form, and this is what I'm looking for. So the green is the old order block, the light blue is the new order block. We have a swing low, followed by a swing high, followed by a lower swing low, followed by market structure change to the upside. Once you change market structure change to the upside, you can define the new order block, the lowest closing bar before market structure change. So the light blue area is the order block. The high is 58.31. The low is 57.79. It's not a very wide order block. So what I'm looking for next week on Budweiser is a rejection of the high of the order block. And again, the high of the order block is 57.79. Or a rejection of the low of the order block, which is, I'm sorry, the high of the order block is 58.31. The low of the order block is 57.79. So if I get a rejection of the high of the order block, I would potentially take that trade. My stop would be a close below the low of the order block. If I get a rejection of the low of the order block, I could take the trade. And again, my exit would be a close below the order block. But I like order blocks within order blocks, and you can see the green is the larger long-term order block. The light blue is the shorter term newest order block. So that's what I'm looking for on Budweiser. Disney. Disney, you know I like these trades. Here we have an order block, and here we have a 200-day moving average inside the order block. So that's a deep dip buy and order block. Next week, first up, if we reject that 200-day moving average, that would be potential entry for me. I like the 200 anyway, but I like the 200 a lot better when it lives inside an order block. And then it gives me a very good risk to reward ratio. Obviously, if we go down, and who knows if we're going to get there, right? But if we do, and we go down and we reject the 200, I can take the trade. If it closes below the 200, then I would look for a rejection of the bottom of the order block. So who knows if it's going to get there, but if it does get there, that's a good spot. And this is how I like to look. I'm like, this is perfect for me if it gets there, right? If it doesn't get there, I'll just go on to another market and wait for something to get to where exactly where I want it to. It's exactly where I want it to. I don't want to buy it here. It needs to do what I need, what I want to the downside, then I'll consider it. FXY is the Japanese yen. I'll give you a little bigger perspective here on FXY. This order block stems all the way back here from 327.25. Swing low, swing high, lower swing low, market structure change. If it comes back to the green, that's probably where I want to buy it. Look here. Came back to the green there. Was that a good place? It certainly was. And now we're getting close again. I'm not super excited about getting into FXY, but you can see in the past, this has generally been the buying area. So I would look to buy FXY with the potential rejection of the high of the order block at about 61.24, or a rejection of the low of the order block at about 60.88, and this is where we combine the two, deep dip buy, order block. Next week, if we go under 30, over 30 RSI, and it happens inside of the order block, then that is where I would enter inside. But if it doesn't do that, I want a rejection of the high of the order block, 61.25. I want a rejection of the low of the order block, 60.88. The only way I would take the trade inside the order block is if we went under 30, over 30 inside the order block, and right now we're 38.27. So I would imagine, depending how quickly we go down, that we could get an under 30, over 30 in the order block. Google. All right, so Google's been on a tear, but Google did change market structure to the downside and did form a bearish order block. So let's see why. Here we have a swing high back on the 16th. Then we have a swing low. Then we have a higher swing high. And here's your swing low right here. I'll draw a line. Okay, here on the 25th, we changed market structure to the downside because we took out the swing low. Excuse me, so let's do it one more time. Swing high, swing low, higher swing high, market structure changed to the downside. Once we change market structure to the downside, I look for the highest closing bar before market structure change. That is the shortable area in the future. So if we rally next week and we reject the bottom of the order block, I would consider getting short there. If it closes in the order block, probably I would not, unless we reject the 70 RSI. Right now we're at 68.46. So rejection of the 70 RSI inside the middle of the order block, yeah, I would take that. So three options: rejection of the bottom of the order block, which is 251.81, or rejection of the high of the order block, which is 256 even, or rejection of the 70 RSI inside of the bearish order block. So, you know, there's lots of different ways to approach this, right? It's just not super mechanical. I mean, it's mechanical in one sense, but different options, like the rejection of the 70 RSI inside the order block. I can already tell from a MACD perspective, MACD, these green bars here, we've made this high on tall red MACD bars. We have pulled back to red now. If even next week we go up and we challenge the highs, we will not have green bars, and we will have what is called a double top bearish divergence, in addition to having the bearish order block. So there's a lot of signals here to me that show I may want to get short Google, but only again if it rejects the bottom of the order block, rejects the high of the order block, or rejects the 70 RSI inside the order block. Coca-Cola, man, nobody wants Coca-Cola ever again, it looks like. But from the perspective of this order block, we are getting close to a pretty decent looking area to buy Coca-Cola. We had this huge order block over here Oh, excuse me, this bar. No, no, no. I don't know how that got all out of whack. All right. So here's a long-term order block all the way from 4/7/25 going into the future. Coca-Cola has just been sold off mercilessly, right? But we are getting close to the bottom of that order block. If we reject the bottom of that order block, that's my potential entry. Doesn't mean it has to go racing up, but all it does is it gives me a very well-defined, good risk to reward ratio after already an immense sell-off. So just specifically, what I am looking for, the low of the order block is 65.08. We're at 65.67. So if we go down another 60 cents or so and reject the bottom, that's where I'll be looking to buy. And if I'm wrong, I could be wrong quite small, just to close below the order block. But Coca-Cola is very oversold inside a long-term order block. I would expect at some point we're going to get a rally, but if it continues down, rejects the bottom, I will consider getting long Coke. If it then closes below the order block, I'm simply would get out of the trade, and then I just have to wait for it to go back up into the order block. That's how I'm looking at it. MasterCard. All right, we have a nice little order block going on here. We did get to the top of the order block, but really what I'm looking for on MasterCard, I want to see it reject the bottom of the order block and that 200-day moving average. The 200-day moving average is at 554.13. We're at 565.13. I'm in no rush to get into MasterCard unless it does exactly what I want it to do. And what I want it to do, and the only really way I'm going to take this trade, is if it heads down, rejects the bottom of that 200-day moving average, and by default it looks like it will reject the bottom of the order block as well. So that's the confluence I'm looking for. I just have to be patient. If it happens, great. Perfect setup with a good risk to reward ratio. If it doesn't happen, I'll just move on to another market. But again, just make this simple. Rejection of the 200-day moving average here at 554.13 is where I'd want to enter. Okay, Meta. I got out of Meta, right? I got out of Meta here on the 22nd because we had to close below the 5 EMA, but we have a nice kind of new order block forming. And why is this order block at the bottom here? Swing low, swing high, lower swing low, market structure change, defines the order block. Now, I am looking for the following. If you look back here on the 2nd of September, we have this big up bar. If you have a big up bar, then halfway of that big up bar is going to be some inherent support. Okay, so we have an area that should have some inherent support, just call it 728, inside of a bullish order block. This is very similar to what I showed you on my short on Amazon, just opposite. Amazon was short, this meta trade is long. So next week, if we come down and test and reject 728, I would consider getting long meta. One, because of the halfway of the big up bar, and two, more importantly, it's in this bullish order block. So just to make it simple, a rejection of 728 would be my potential entry point. My stop would simply be a close below 728. So I can keep that stop really close, really tight for a good risk to reward ratio. So we'll see what happens. Certainly could happen. Merck, MRK. Well, Merck has really had a sell-off here, and we're coming back to a nice bullish order block that started back here on the 28th of May. You can see we had the order block, swing low, swing high, swing low, market structure change, came back down, almost tested the top of the order block, went back up again. This bar here, big down. Where did it stop? Where did buyers come in? The top of the order block. Shot back up from there. If we come back down, is that going to happen again? I don't know. Probably more than likely, but not for sure, right? So that's why I have to set up the trade. So really what I would be looking for at this point would be a rejection of the high of the order block at 76.24. My stop would be a close below the low of the order block, or obviously a rejection of the low of the order block at 74.10. or a rejection of the 30 RSI inside the order block. So that would be the combination of deep dip buy with the order block. So I obviously I don't know what's going to happen, and I'll just have to see day by day what this looks like. But just off the top of my head here, rejection of the high of the order block's potential 76.20, rejection of the low of the order block 74.10, and or rejection of the 30 RSI inside the order block. Palantir, PLTR. Okay, this is a bearish order block because it's red. You can see back here on the 13th of August, we had a big down bar. I put a line here at halfway the big down bar, 186.30. That's going to be some inherent, most likely be some inherent resistance because it's a big down bar that you rally back up to halfway that big down bar. It also happens inside the bearish order block. I almost had this trade last week here on the 23rd. You see how close we got to halfway of that bar inside the bearish order block? It never rejected it, so I didn't take the trade if I had, but it did go down from here. So you can see it got almost within, I don't know, probably 20, 30 cents from exactly where I thought the resistance would be, and that's what happened. So we'll see what happens. If PLTR, Palantir, does go up, reject 186.30, I potentially take the trade. My stop would simply then, my end of bar stop would simply be a close back over 186.30. Let's go to Shopify. Okay, Shopify, we have a nice order block below here. Why the order block? Swing low, swing high, lower swing low. Market structure change defines the order block here. The one spot that I'm looking for is 136. Why 136? Because if we go over here, we have the big up bar. Big up bars, if you go back to halfway the big up bar in inherent support at 136. So you have inherent support at 136 inside a bullish order block already. So it makes sense. Just to make it simple, if Shopify comes down, rejects 136, that would be my potential entry spot. My stop, my end of bar stop would simply be a close below 136. So we keep those stops really tight. Last but not least, yay! Thank goodness. I've only been doing this podcast like 9 hours long. VIX. I talked about VIX last week. I said we could potentially change market structure to VIX on the upside. Well, we have done that. Look, here we have a swing low. Here we have a swing high. Here we have a lower swing low. If in the future, when that happens, if we go above the swing high, it changes market structure to the upside. Well, for 3 days last week, we did get over, closed under, but it's okay. It did get there. This technically changed market structure to the upside. So if it changes market structure to the upside, the bullish order block is the lowest bar close before market structure change. That is this here on the 18th. The high of that order block is 33.31. The low is 32.63. I drew the order block into the future. Well, we are smack down, dab inside that order block. So do I buy it here? No. But if we reject the bottom of the order block next week, I think that would be a very interesting entry with the rejection of the bottom of the order block and a very good risk to reward ratio. And I mentioned if we break market structure to the upside on VIX, very likely that will be bad for the market, and that's exactly what happened. So VIX was down big on Friday. Does that mean immediately that everything's okay now? No. No, it doesn't. If VIX closes below this low, then yes, we could go back up and make new highs. But this is a very interesting area to buy VIX. Again, because we change market structure. Once you change market structure, you have a pullback. That's generally where it's going to bounce. If we bounce here on VIX, market very likely go down. So I think we're at a very interesting crossroads with the market here, especially vis-a-vis what VIX is telling us. So I would not be surprised if we go down next week with the market just based upon this VIX chart. But if VIX closes below the low of this order block, I'm not going to get in the trade. But if it rejects the low of 32.63, I would consider the trade because it would give me a very good risk to reward ratio. So anyway, that is all I have for you today. I hope you learned something. I hope you found something of value. If you did, I would really appreciate it if you could hit the thumbs up button or subscribe to the channel. It helps out the channel a lot. It lets YouTube know there's some proper value here. If I can help you with your trading, I'd love to have you as a student. I also do private consulting for all sorts of various things in trading. But if you'd like to be my student, just send me an email. We'll get the conversation started. I'll teach you everything I know, and you'll be a much better trader. So hope you have a good weekend. Please try to go out, try to do one nice thing for another human being every day. It would make the world a much better place. Try to go out and do one nice thing for an animal each day. It would make the world a much better place. They appreciate acts of kindness just like we do. But if you have any comments, questions, please put them in the comment section. I'll do my best to get back to you as soon as I can with an answer. But again, thanks for listening to the podcast today, and I hope it was helpful for you. Take care, everyone. God willing, I'll see you next week. Take care.
U.S. government required stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.